Welcome to today's lecture. Today we'll be looking at elements of risk and return. In our continuation of discussion regarding the business finance from the conceptual point of view for the beginners, today we will focus on the elements that are very crucial for a business and financial manager. Today we will look at what a return is for a business finance person as well as for businesses themselves, and indeed what the risks are regarding the financial activities. The basic of risk and return. Return is the amount received by an investor as a compensation for taking on a risk of a particular investment. So if you have invested funds, what you are practically doing, you are actually taking a chance which have the likelihood that you will come out with something of benefits, and also the potential that the value you actually put in will get eroded and you will not come out with anything. And therefore, from the finance point of view, for you to make a return, it therefore means that you are actually risking something, and that thing you are risking, the benefit from risking that, it is the compensation you get from the return on investment. And what do we call a return on investment? Return on investment is the difference between the amount you actually earn from that investment and the initial amount that you have actually put into that business. So whatever the difference is up, it is what we call the upside from the economic point of view, and from the business perspective, you can call it a return on investment. Now, a return on investment also can be calculated or be composed from a percentage point of view. In other words, you can decide to take a percentage of return on investment looking at what the actual benefits are from the investment divided by the total initial capital that was invested, and you will have a percentage composite of what rate of return is. So you have two elements in returns. You can have a return on investment, which is a lump sum of amount of money that is earned from an investment, or you can also calculate what we'll call a return on investment, which is a percentage composite of that return that you have earned from an investment. Now, let's look at the other side of the equation. Return, risk. From the risk point of view, now if you have a risk by definition is an event that will likely happen to prevent you from achieving the stated objective. And therefore, if an event crystallizes or materializes, as a financial and a risk expert calls it, it therefore means that you may not be able to achieve the objective. From the finance or business finance point of view too, you have events in the marketplace that can prevent an investor from actually realizing the benefits of those investments. And therefore, we define risk as an element of variability between the actual return that you get from an investment and what the expected return was. If you invest 1 million naira in a business and your expectation was that maybe I will earn 200,000 as a profit or a return from this investment, and at the end of the day, going into the market, investing the money, you end up getting, let's say, 120,000 naira. The difference between your expectation of 200,000 and the actual of 120,000 that you generate, it's what we call a risk. That is the portion that your estimate or your forecast is not able to capture real time, because whatever you have as an estimate with regards to risk or return, there is an element of variability that are likely going to happen due to forecasting error or due to the fact that you lack the perfect information regarding the decision elements. Now, we look at the two categories of risk that we have, that businesses, finances actually faces. We have what we call a systematic risk, and then we also have what we call an unsystematic risk. A systematic risk, by definition, is what we have as a market risk, which is an undiversifiable risk, meaning that everybody participating in the market will face the similar risk. For instance, we had a pandemic that struck the global economy in 2020. This is an indication that this is a market risk because every single individual that participates in the global market faces one or two challenges as an outcome or a consequence of COVID-19. So everybody, irrespective of your industrial classification, whether you operate in the telecom industry or fast consumer moving goods industry, or you are in an extractive industry, oil and gas, healthcare, it doesn't matter. Every single industry were affected by the same incidents. And therefore, the impact of that variability on the earnings of those companies across these sectors were all affected, and that is what a systematic risk is. So you can't hide because it is undiversifiable. The fact that you say, okay, I am not going to invest in telecom, I should rather de-invest my telecom securities and go into a fast-moving consumer product industry. That does not exonerate you from the risk element because it is a market risk, it is a systematic risk, and it is a risk that you cannot be able to treat or avoid by diversifying into another business venture. The second element of the risk is unsystematic risk. Unsystematic risk are what we call a diversifiable risk or a company risk. Now, these are particular risk, specific risk, risks that are embedded or inherent in a particular activity. If you have an unsystematic risk or a company risk, it by definition means that that risk only accounts to the company or the business activity you are carrying out. If you decide to forgo that business activity and go into another business activity, that risk may not be present or it may be treated. So it therefore means that with unsystematic risk, you can be able to alleviate, to treat this risk by foregoing the activity, stopping the activity, and going into a different activity altogether. From the business finance point of view, if I decide to invest my shares in the telecom industry and decide to go into oil and gas, then this by unsystematic risk, the risk that I face from the telecom is gone. And then I will be taking on in another risk because of the new activity I am taking on, or the new business I actually am investing my funds in. So these are the differences between the two. But in any case, risk is a concept that is underpinned by variability of your expectation vis-a-vis the actual of those expectations when they materializes. So other types of risks that investments actually face in business financing are the ones we have listed on this slide. The first one is the credit risk. Businesses actually face credit risk from the point that you will extend credit, because the concept of business finance is a situation whereby you mobilize resources from the surplus environment to a deficit environment. In other words, you are actually going to those areas that have a lot of money to spend and move the money to those areas that have less money to spend. People who have a lot of disposable incomes will be able to save, and the banks, commercial bank, investment banks use these funds to actually lend credit to other people that have their need for the money or have investment opportunity for which they lack sufficient funds to actually finance them. Now, why do you have the credit risk? Credit risk is embedded on the factor of default. If you extend a credit extension is an activity, and the variability there is the likelihood that the person you are extending the credit to may default. In other words, the person may fail to pay back when the due date arrives. So these are the elements in the business that venture capitalists, banks, investments, and other financing institutions normally take on board when they extend credit. They extend credit by looking at the credit capability and also competency of individual requesting for credit, and also the amount in terms of the risk they are able and are willing to take on board given a particular return that they are expecting. The next one is foreign exchange risk. Risks regarding the viability with respect to the purchasing power of two exchange rates. In other words, what is the purchasing power of a dollar vis-a-vis the naira, and how does this purchasing power changes over time? In our previous lecture on time value of money, we did emphasize that business finance and activity of finance are underpinned by the time value of money. In other words, the purchasing power of money actually changes as the time passes by, and with time passing, the value of money may increase or the value of money may decrease depending on the circumstances and other macroeconomic fundamentals facing those currencies at that time. It therefore means that for an exchange risk, you have the tendency of variability between the value of one currency vis-a-vis the value of the other currency. If I had, let's say, 1 million naira in 2020 at the beginning, the exchange rate of naira to dollar at that time was far, far less than what it is today. It therefore means passing of time between 2020 to 2021 have actually eroded the value of naira vis-a-vis the value of the dollar. So that is the risk that we face when you get into exchange rate risk discussion. The next risk is interest rate risk. When you are extended a credit, there are usually a cost attached to those credit. If you approach a bank or an individual to borrow, the tendency is that you are not only going to pay back the amount that you borrow at the maturity, but you will also have to pay for the cost of that borrowing. And the cost of that borrowing compensates the person extending the credit for the time the person have taken to borrow you, and also for the risk the person have taken in terms of the time value of money, and also the possibility of credit risk, which is that you may default and you will never pay back. So the interest risk are the variability between interest rate. The tendency that the interest rate that you have already on your credit, on the loan that you have borrowed, may increase over time. And also for the creditor that extend you the credit line, they also face the same interest rate risk. The risk that the interest rate will be reduced over time due to financial fiscal policy of the central bank or the monetary policy that the country is undergoing at that point in time. So this is another risk element that is linked to the credit risk. Two people are involved in the credit, the borrower and the lender, and each and every one of them actually faces the interest rate risk. While one person will profit from the fact that the interest rate increases, the other guy will actually be facing a loss, and therefore will prefer a situation whereby the interest rate will reduce, and that is the borrower's end. The borrower will always prefer that the interest rate should reduce, and the lender will always prefer the situation that interest rate will continue to increase, so that they'll compensate for whatever erosion that they will have in the time value of the money involved in that transaction. Then you also have what we call industry risk. Industry risks are like a company risk. They are specific to a particular industry, and each industry in any given jurisdiction faces different regulatory environment, and those regulatory environment drive the kind of variabilities you see, and also the fact that some industry also operate at different industrial life cycle. There are some industry that are at the growth stage. There are some industry that are still at the introduction stage, that are still trying to mature, and you also may have some industry that are already mature, less space for expansion, less space for growth. But you will also face some industry that are already at the declining point, meaning that they are less to actually gain staying within that specific industry. Therefore, you will have an element of variability between what the prospects are vis-a-vis what the expectation was at the beginning. Then you also have what we call a political risk. Political risk is the tendency of instability in the government policy, whether in the government itself, the fact that government may actually be overthrown, like in those days that we normally have significant military interventions, or because of the fact that you will have a situation that the Americans face, like in the last 2 months, where you have the case of insurrection, people actually go into the parliament, disrupting the parliament proceedings simply because they are aggrieved regarding who actually won or who actually does not actually benefit from these election processes that they had at that point. So these are all risks that businesses face. If government changes, if government orientation about a particular sector changes, it is a risk element for businesses that operate in those jurisdictions or in those sectors, because the likelihood is that you will have an unfriendly government policy for which your businesses may not be prepared to actually cope with. Then you also have the last one, which is the liquidity risk. Every businesses are based on the fundamental of going concern. In other words, every businesses have the fear life of continue to operate long term, even beyond the life of those people that set those companies up. And in that rhythm, it therefore means that in order for you to continue to exist, there are risks that you face, which is the risk of immediate. Immediate risk is the liquidity risk. And by definition, liquidity risk simply means your ability to meet your short-term obligation and still be able to continue business on the short term. What are these short-term obligations? Obligations like the salaries and wages of your workers. Obligation like the electricity bills and utility bills that you need to pay for your businesses to operate. Bills like the telephone bills, administrative bills, other marketing and distribution expenses that you need to pay in order to move your goods from one place to another. These are all liquidity risks that requires company or businesses bringing out of pocket to finance those expenses. So in other words, if you cannot be able to finance those immediate expenses, then you run the risk of illiquidity. In other words, your ability not to be able to meet this obligation that are fall due within a short period of time. Liquidity obligations are usually from 0 to 12 months. Any obligation that are within 0 to 12 months are current obligations, and they are categorized as liquidity. So the viability, your inability to be able to meet those risks actually poses a liquidity risk for the business, and therefore it is a potential that the businesses may not be able to survive. This is of course different from what the solvency risk is, which is on long-term basis. Liquidity risk actually focuses on the short-term obligations. Now, in continuation, we get to a stage now that we need to look at, having analyze the concept of return, which is based on the upside from your investment, and also the variability regarding those return and earnings, which is a risk. What is then the relationship between return and risk? From the two definitions, we can see from the two definitions that, of course, risk and return are simultaneous factors that need to work in hand. In other words, a risk is the likelihood that you may not be able to achieve the objective. And therefore, in order for an investor to invest, he must be incentivized, he must be enticed by a return that compensates for the risk and time that they have to take on that investment. So the relationship between the risk and the return actually focus on the level at which an investor would be incentivized, will be motivated to actually take on particular investment, taking into account the risk of that investment, the risk and return of an alternative investment opportunities. Because at any point that organization want to invest or want to extend a particular business venture, that particular business venture are not usually the only alternatives they have. They also have alternative to invest in other aspects of the businesses or to expand or to do other things. Now, in order for an investor to be incentivized regarding going into this alternative business rather than the other substitute alternative, the incentive must be a return that compensates for the risk of that particular investment and also the risk and return of that alternative that they will have taken if not if they have decided not to take this particular one. And then the next one would be your attitude towards risk itself. To what extent are you open to taking risk? To what extent are you open to accepting the fact that the return you have in your mind may likely be different from the actual return that you will get from the business when you go into the marketplace? So these are the three fundamentals that guide the relationship between risk and return. The risk of the investment, the risk and return of alternative investment, and also the attitude of the person investing towards the risk itself. Now, you now have three categories of people who actually do investment in business. One, those that have a risk-averse perspective or sentiment. These are people that don't like risk at all. They don't accept the fact that there will be a viability. So they have what we call a diminishing marginal utility for wealth. As they continue to make more money and invest and make more money, it gets to a stage whereby their satisfaction actually reduces with additional investment they make. And then you also have another category of people that are risk neutral. In other words, they are indifferent. Indifferent regarding going for an investment with a risk and also avoiding investment with a risk. Then you have the third category, who are individuals that are actually in the market looking for those risks, looking for those businesses that have element of risk in them because they speculate and they profit from those speculation. So from the risk relationship point of view, you have a return and risks that have what we call a linear relationship, which shows, or an inverse relationship, which shows that as you have a linear relationship that shows that as the risk of an investment actually grow, so is the return, or as the return grows, so is the risk that are usually attached to an investment. And then, of course, you have three categories of people that actually are associated with investment. The investors per se, perspective that they have, neutral, averse, and those that are optimistic about taking the risks that the company faces. So this takes us to the next model, which is financial markets and institutions. We have discussed what the concept of finance is. We have also discussed the decisions that faces a financial manager, ranging from investment decision to financing decision to dividend decision and also liquidity decision. Now, where is the market where this activity actually takes place? And that is what we will be discussing in this module. And it is called financial markets and institutions. What is a financial market? A financial market basically facilitates the creation and transfer of financial assets and obligation. That's what they do. They facilitate the creation and transfer of financial assets and obligation that are actually attached to those financial assets. It therefore means that the two sets of people have to come in order for you to have a financial market. One, an individual that have money to invest, and an individual that have a financing needs. If you have an investment and your investment is a proposal that is promising a lot of profitability, in most cases, organizations with those kind of genuine projects don't have complete finance to finance those projects. They don't have complete funds to finance those projects. So you will need to approach individuals or an agency or a platform that have an avenue of bringing people together, people of different perspective, people of different inclination in terms of their financial disposition. One that has a lot of sufficient funds that they want to actually invest, and the other that actually have credible business proposal, but they don't have sufficient financial backing to carry out that project. You can now see that there is a convergence between the two parties. One has sufficient funds that they don't have need for, and the other have an opportunity for which they need a funding for. So this one is a situation whereby you will create a financial platform that brings the two people together and actually consummate the contract of the financial obligation for each party. Each party will have an obligation that they have to meet, and each party will be held responsible for those obligations. Then you also have a transaction that will be created because of these two people that comes together. One is the owner of the funds, and the other will be an individual looking for funds. So it therefore means that person looking for funds will actually be able to request for funds, and also will be able to pay for the cost of that funds. And the person that owns the funds, which is being requested, will now earn not only the principal they are extending to the borrower, but they will also earn from the cost of such borrowing, because they need to be compensated for the risk they are taking, which is the possibility of default, as we have talked about in credit risk, and also the possibility and also variation with regards to time value of money, which means that the value and the purchasing power of the money of the finance will change as the time passes by. Now, we need to also highlight that the fact that when you talk about financial market, people would think maybe it's just like a market square, where you go to a particular market or you go to a particular departmental store with an address. It is not a place. It is simply the totality of the money that is in circulation with regards to the supply and also the demand for such money. People who have sufficient funds will want to invest in business alternatives that give them profitability, and people who have less will want to go into the same arrangement or market to actually be able to attract more funds so that they can invest into their businesses for expansion or for whatever purposes that will derive future benefits. Then we have two types of market with that regards. Because the financial market provides an avenue where monies are actually mobilized and people can come there to attract more funding for their businesses, there are two categories of market. The market that is short-term oriented and the other market that is long-term oriented. We have a money market, and then we also have what we call a capital market. A money market traded on debt securities with maturity dates that are within less than a year, maximum a year. It therefore means that this is a typical short-term obligation. People who have income that they don't have need for, but they expect that within a year they may have need for those income, will usually approach the money market and actually invest their money in money market securities. Securities such as government treasury bills, notes, bonds, commercial papers, certificate of deposit, and bank acceptances. These are all short-term financial securities for people that have sufficient funds that they don't have immediate need for, but for which they will need within that same year, will likely going to invest in the money market. But you also have what we call a capital market. This is where you can find people who have funds for a long-term investment. They are willing not to actually use those funds for immediate or within a year. They can use it maybe mid-time to 1 to 5 years or 5 to 10 years or 20 years as the case may be. Then it depends on the business orientation that the firm has and the need for those funding of those businesses. Then you will that will determine which of the market you approach. If you have a short-term market money needs, then you can approach the money market. But if you have a long-term need for funding, then your best bet is to approach the capital market. And then, of course, we also have the capital market in Nigeria, which is the Nigeria Stock Exchange, which is a classical example of a capital market. Then the next one is, the next slide talk about the intermediaries, because it's a financial obligation. In financial institutions and markets, what you have are individuals that actually facilitate the transaction between two parties. These two parties we have identified, the one with more funds and the other one that is in need of funds. Then how do these people actually come together? They come together through a medium that is created by the people we call the financial intermediaries. The financial intermediaries are individuals that help create and exchange instruments of financial markets. They include the commercial banks, the life insurance company, the pension fund, the mutual funds, credit unions, and investment banks. These are all institutions or organizations that are set up as an auxiliary or supporting organization to these two parties that we have in the financial markets. So if you have sufficient funds, your best bet will be to approach a financial advisor, either in the investment banker space, to actually advise you on what to invest in, and they will also provide an advice for people that are in need of money. So they are able to see clearly the two parties at the two ends of the business section. The ones with sufficient and the other ones with seeking more sufficiency. Now, when you have a financial market, one of the key things in the financial market are the securities, which are the articles of trade. Securities in terms of whether it is government bonds, bills, treasury bills, debentures, certificate of deposit, commercial paper. These are all instruments that are traded in the financial markets. Now, in order to guide the investors in the financial market on the reputable and the high quality of the securities to invest, you have what we call the rating agencies that rate the quality of debts or securities being offered by those companies seeking for funds, so that you don't end up investing in a company that you face significant credit risk, which is possibility of default. And we have two of them that are the most popular globally. We have the one we call Standard & Poor, and then we also have Moody's. These are two agencies recognized globally for rating securities and also the company that issue those securities. They actually rate them from the high quality companies with high quality securities, and to those companies that have basically a junk or a poor quality security or debts. Now, you have these rating agencies. Their main objective is to protect and guide the investors. Is to protect and guide the investors in their informed decision regarding what to invest in, the securities to buy, and the risk that you face with those securities. Now, what you can see in the marketplace, especially in the financial marketplace, some securities have an attached high rate of returns. The high rate of returns signifies in the financial market most time the risk that is inherent in those securities. So, and that's why you see things like treasury bills, security like treasury bills that are issued by the government, which are almost a zero default risk, have a very lower rate of return. If, for instance, a government treasury bill is doing, let's say, 2%, 3%, 5%, you will see a commercial paper which are issued by a private company doing like 10, 12, or even 15%. This shows significant level of differential in terms of the expected income. So, a naive investor may be tilted into going into commercial papers rather than looking critically what the credit default of these two are. And it does not mean because the interest rate is low, the default risk is low. But the interest rate actually mirrors the protection that the security actually has. And that is one of the key elements that business finance experts normally take into account in giving a financial advice. From the rating agencies, they have two categories of ratings: the high quality securities and then the low quality securities. How do they come about rating these companies that actually want funding for the money for their businesses? They actually go into their financials, the financial statements, their governance structures, the board of directors, the competency of the management, and also their recruitment processes, and how generally they abide by the principle of corporate best practices, corporate governance best practices, their audit, their assurance processes, and also their internal governance structures. So these, including with their financial, allow the rating agencies to come up with a particular rating attached to those securities. And at the end of the day, you will either end up with a security that is rated AAA to a security that is rated a D. A security rated a AAA means an high quality security that if you invest in, you have almost a zero default risk because the high quality of the investment as well as the high quality of the company that is issuing those securities. But if you invest in a D, there is likelihood that the return on investment from a due security may be higher than the triple A, but the implication is there is a significant tendency of default, meaning that you may end up not getting anything out of that investment at all. Then you have the middlemen guys. You may have a security that is rated A, BB, BBC, or simple B, which are basically an investment grade. They are companies that issue security, but they have a track record of meeting up with their obligation without defaulting. That does not in any way means that these companies are actually above those with the AAA, but it just tells you that these are companies that issue a debt of high quality that may not be up to AAA, but they have capability of meeting their obligation when they are due. So this is where we come to the end of this lecture series, and we'll see you again in the subsequent series. Thank you.